Young's Item Club says the Bank of England should keep rates at their record low. The forecaster has cut its growth outlook for the UK, saying the economy may struggle to gather strength as the government cuts take hold. But it says a bigger threat to recovery could come if the central bank moves to tighten policy. With us is Peter Spencer, Chief Economic Advisor to the Item Club. Peter, good morning. Thank you for joining us.
Morning, Mark.
So, Peter, your message to the MPC, don't move on rates yet.
Yes, hold your nerve. As many on the MPC believe, inflation is going to come down next year, and it is going to fulfill its remit. And, of course, again, as Mervyn King has been arguing, a rise in interest rates wouldn't really do very much about the high levels of inflation we're seeing this year.
Will your calls fall on deaf ears? Obviously, right now, rates are unchanged, Peter, but three are voting for higher rates. Are we moving towards higher rates, maybe sooner than you want?
That is obviously the worry. It's, dare I say, very difficult to predict the decisions of a committee, particularly when it's dominated by economists. But I think that there's every chance that they will be able to hold out until towards the end of the year, say November. And of course, if they raise rates then, the inflation will be coming down. The pressure on George Osborne's hard-pressed families will be easing. That would be a good time to raise interest rates, just like George Osborne has worked out that it's a good time to be going through with his postponed 5p increase in fuel duty. So there's a lot that actually points towards November.
So, Peter, what you're saying is you think we're going to get through these tough austerity times. You do see already light at the other side.
Absolutely. And most obviously for large companies who've in many cases had a pretty good kind of recession, and they're now plugged into a very strong world economy where the growth that obviously we've seen in the Far East is clearly broadening out into countries like Germany and the US. And those companies are in a position to tap into that. They're already doing that.
So business spending will account for the drop-off we see in consumer spending?
It's the consumer that is obviously the worry. Hopefully we'll see a little bit of growth there, but the point is that that will be augmented by a better trade picture. We're already seeing much better contribution from exports, with imports slowing, and business investment will add to that growth too. Looking
at your GDP forecast, 1.8% this year. I think the government would probably take that after the first quarter. Next year, 2.3 and 2.7 in 2013. So, going back to trend within a year or two.
Yes, I mean, what happens is that just as you've seen that broadening out of the growth process in the world economy, we will see a broadening out of growth from those large companies, export-dependent companies, to investment spending generally. That will trickle down to smaller companies, where, of course, the jobs are going to come from, and hence the relief for the household sector.
Peter, always a pleasure. Speak to you soon. Peter Spencer there, Chief Economic Advisor at Ernst & Young Item Club.